Yeah, and so the 5-year note that was issued, 4.5 years ago at less than 2% is going to roll over at 4.5 or 4.75%.
Right.
That is meaningful, a meaningful increase. And you multiply that by, all the 3-year notes and 5-year and the 10 years issued, 8 years ago.
Mm-hmm.
That means that if rates just stay where they are over the balance of this year and next year, interest service, the service on the debt is estimated to almost double from here, even if rates just stay where they are. It's higher than the military, and also just that was last month, and now this month is past Medicare.
Jeez.
So it is, depending on how you break the budget down into what components, it is the largest single component in the budget, and it's a component that really isn't discretionary, and it's only going to get worse if rates stay where they are or anywhere close to where they are, because even if they come down from 5 to 4, that's still more than double what the notes were 5 years ago. And of course, that's why Janet Yellen made a trip to Beijing, pleading with China, please buy our bonds. Truth is, China has no particular incentive to buy US bonds right now. Yeah, China is selling aggressively. Russia is already out, of course. Of the big three, China, Russia, and Japan, Japan is the only one still buying. And frankly, last month they bought a lot, or the last month that was reported, I think that's probably April. April. They
Right.
bought a lot. But I think that's going to change when you think about it, 2 years ago, 3 years ago, 4 years ago, you're a Japanese insurance company, pension fund, institution. Do you buy?
Real World Asset Wealth: How to Protect Your Wealth from the Upcoming Financial Impact. Download this brand new report for free and get instant access to our resources. Click the button below the video now.
A Japanese bond that has a negative yield, meaning you're guaranteed to get less back when it matures, with the yen falling, or do you buy a US dollar bond at 3, 4, 5% where the dollar is strong? Well, that's a no-brainer.
Yeah.
That's a no-brainer. But as interest rates in Japan move back up and are now positive, the 10 years like almost 1% now. The yen, after having fallen, is just beginning to slowly appreciate a little bit. That's an open question as to how far it goes.
Right.
I personally think it'll move further. But as the interest rates in Japan start to move up, particularly if the US starts to cut rates, that dynamic completely changes. Because in absolute terms, US bonds may still be yielding more than Japanese bonds.
Right.
The directional change is in favor of Japan. And if you're a Japanese investor, right, your bias is to buy Japanese bonds anyway. So you only buy foreign bonds when the discrepancy is so great. So as the gap narrows and the change, the change of direction persists, I think Japanese will start selling US bonds, or at least when they mature, they will buy US bonds. So foreign buyers we shouldn't expect a lot of buying from foreign buyers. Right. Well, I don't think it'll be quite, China will go to the same level as Russia anytime soon. But if we move in that direction, then the market, so you're left with who's buying US bonds, right? The Fed is allegedly reducing its balance sheet, so they're not a big buyer. The Social Security Fund, which is another big buyer of US bonds, the Social Security Trust Fund is shrinking as we have more people taking money out now than putting money in.
Right.
So the trust fund is shrinking. So although they'll continue to buy bonds, that's what they do with their money, they have less and less and less of it as time goes on. And even US banks, the regional banks, are a little cautious about buying bonds because of that whole mess with mark to market that we had, hold to maturity, but we had last year with the US bond, with the regional banks.
Right.
And the investors that are buying bonds, whether they're hedge funds or whether they're pension funds or whether they're individuals, you know, they will demand a higher yield. They'll demand a higher yield.
Yeah.
I mean, why would you buy? I don't know why anyone will buy a 30-year US government bond paying, what is it now, 4.5%?
Yeah.
When inflation is, CPI is at, 3.5 or something. But so people are just going to begin to demand, with fewer buyers, people are going to demand higher yields. They've already had several auctions, auctions of treasuries in the last couple of months that have been very, very weak. And the 7-year treasury auction, 10 days ago, was excessively weak. And the dealers were left holding a lot of the bonds. Well, that means people are just going to demand, they're going to have to pay more to get people to buy. The other alternative, of course, is that the Fed changes direction. They don't have to lower rates, but they start to monetize the debt. And I think that is a high probability. And that, of course, will be very inflationary, as we've experienced before. But I mean, that's the only answer. If people are not buying a debt and you have to raise rates to get people to buy, but you're trying to lower rates to ease the economy,